Major funding for these programs is provided by the CUNY TV Foundation, Capital One Bank, Geneva Burns, Gian Tomasi and Webster, Chase Commercial Term Lending, Perfect Building Maintenance, the Witkoff Group, New York Community Bank, M&T Bank, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP. Additional funding is provided by Ariel Property Advisors, Bank of America Merrill Lynch, Bank Leumi USA, Briarwood Organization, Colliers International New York City, Cushman & Wakefield, Customers Bank, DDG Partners, Dime Savings Bank of Williamsburg, Eastern Union Funding, Flushing Bank, Friedman LLP, Herrick Feinstein LLP, Hersha Hospitality Trust, Investors Bank, James D. Kuhn Real Estate Institute at Syracuse University, James Orphanides Centurion Holdings, Margolin Weiner and Evans LLP, Madison Realty Capital, Massey Knackle Realty Services, Matone Group, Meridian Capital Group, Newmark Grubb Knight Frank, New Banks, People's United Bank, Popular Community Bank, RBS Citizens Bank, SJB Properties, Sterling & Sterling, Stonehenge Partners, Urban American, and These Friends.
Here we are, September 2013, the 13th anniversary of the beginning of the Stoller Report, which had its original origins at 11 o'clock at night from a restaurant in Midtown. So where are we today in the world, with the economy, with the world of banking? Where do we see the world going? Is it good? We've seen Treasury bills go from a 1.5% on the T-bill to close to 3%. We've seen land prices go up to highest levels that we've seen pre-2007. We see exuberance, irrational exuberance around. So the people who make the decisions to lend to people, to develop properties, to build properties, to refinance properties are the bankers. So I've assembled some prominent bankers to provide their insight on how they see 2014. How is my apple going to glow or not glow in 2014? My guests, they include Gino Martocci, who is the Metro Regional Executive for M&T Bank, John Costa, who is the Executive Vice President for People's United Bank, Domenick Cama, who is the Senior Executive Vice President and Chief Operating Officer for Investors Bank, and last but definitely not least, my friend Rick Lyon, who is the Executive Vice President for all commercial real estate for Capital One Bank. So where are we? You and I have seen good cycles, bad cycles. Where do you see this cycle?
Currently, there's still a reasonable amount of discipline in the market, particularly the New York market, where there's a lot of equity in deals. You mentioned land prices, $600 a square foot, because it's premised on $2,500, $3,000 square foot.
Wait a second, land. I just saw a deal that closed in Lower Manhattan by a garage guy who I knew, who I won't put any bad comments. Thank God he sold the property. $1,100 a square foot for the land.
It is a non-corner site, if I remember to say.
Right. So yeah. It's expensive, and how high can condominiums sell for? I mean,
I think there's no one who knows how deep that market is. I'll saying that everything that we're involved with is amazingly selling out at prices nobody would have predicted. We just have to be very, very selective about how you go forward and what your break-evens are.
I think when you think about 2014, to think about the future, a lot is going to depend on the level of interest rates and what happens there.
But I brought up the fact, what do we see with interest rates? I mean, there were banks over there. I mean, all of you were lending, when T-bills, it depends on what you put your basis is, okay? But the Treasury today is 3%. And, there's a refinancing risk over here, which we've seen from not you people over the years on the situation. Interest rates are rising. Bankers, we were saying prior to the show, bankers have, in certain cases, to meet their numbers before the end of the year. They have to reach, I won't call it a quota, but there are bonuses. There are other situations. There are new banks entering the market that we discussed before. All of this has an effect that, we're disciplined, but I still remember discipline in 2007. What happened? There wasn't discipline in 2007, right, Mr. Lyon?
True, there wasn't discipline. There was a lot of other sectors that came into the market besides the banking. You had CMBS, you had that whole side of it.
Construction CDOs.
CDOs,
who would've thought?
all of that, which is interesting. A lot of that, the hedge funds are back into the lending game a bit. But I think one of the most important things right now is I don't see it overly exuberant. I do see still a lot of equity and a lot of discipline in credit structures, and so we're not throwing too much liquidity at the marketplace. So we seem to be in a very stable environment. The biggest risk that we worried about were interest rates. So a rising interest rate going to a 3% Treasury is a good thing. I got very nervous about a 1.
You make more money.
Well, actually, making more money, isn't the issue, and we don't necessarily on a lending side.
I know, but I'm joking because certain people tell everybody you make more money.
But the real point on that is it's scary to look at a cap rate spread when you're taking a Treasury at 1% and saying, geez, my average is a 2.5 spread, so I should be buying things at 3.5. That's tough if interest rates spike up 200, 300 basis points.
In terms of us as lenders maintaining discipline, how do you underwrite your exit? I mean, the loan's only good when it pays off, basically.
One of my dear friends said to me, as a banker, the nicest thing, I don't mind getting repaid. It's nice to get repaid, okay? I don't like not getting repaid. So the exit, it's great you put the loan out, you make a commitment over here. What's the source of repayment?
We're sensitizing interest rates and rental rates, but right now what's protecting the banks is the amount of equity in the deal.
Yep.
Should that start slipping to 80% again, then you got to then you've really got to be focused.
Okay, Gino, here. Okay, let's look at it this way. You do a lot of multifamily business. You do a lot of multifamily business, and you do a lot, and you're going to be doing more now with the Beach Street over there. And you do selective multifamily.
Well, we do. We have M&T Realty Capital.
No, that's the Fannie Mae a similar situation. Let's look at this situation. You have a scenario that somebody bought a property, and I've seen this happen in 2008. They were lucky. They bought 2008, 2009. They've been able to, because of the New York City amount of people wanted living to New York, they've been able to get a higher rent. So they refinanced it once, they then refinanced the second time. These multifamily owners, as opposed to a construction loan or something else, have no skin in the game. They have cashed out, and some of these cash outs are very young borrowers who have nothing over there because they were in the deal, they were fortunate, they built up the asset. Now I don't believe there's equity in the deal. They'll give you the keys back if they can't pay you when the mortgage.
We're not doing the long-term takeouts. So.
Well, we're more term lenders, but again, you're looking at this the same way. If you underwrite this to the right people and the right parameters going in, and it is multifamily rent stabilized in the city, provided they can manage this, you should be able to exit it okay. And look, the first thing we look at is who are we lending money to. It could be a beautiful building. If the sponsorship isn't there or isn't competent, we're going to walk away.
Yeah, it's the same with, and the regulators rightfully look at this. Interest-only loans are dangerous if the interest-only is structured because they really can't pay amortization, right? We always say, I'm happy to do an interest-only if I'm starting where I was happy to end, right? And that makes sense. But we think that, longer term, we are doing some longer term. Longer term with good amortization, starting at a good basis with a good debt yield, that you can calculate a very reasonable takeout at the end. And that's really what it is.
Let's talk a little bit about your recent acquisition in Beach Street. You were on the other side a number of years ago when you were at Sovereign. You've sold it over there. You talked about M&T Realty Finance. You're heavily active. Why Capital? What's the reasoning for buying a Fannie Freddie?
Well, again, we like the long-term demographics in the apartment marketplace. We think it's a good, stable asset, relatively low-risk asset when you look at all real estate out there. So we like that business, first and foremost. Secondly, this gives us optionality and a full product set. So we can offer our client either our balance sheet, we can offer them the Fannie, Freddie agency executions, a HUD execution. We will build a conduit and offer them those kind of executions. So depending where capital's flowing, we can offer that to our clients, and that's really the whole premise for this. It's not just to get into the agencies, but it's really to build an entire
just trying to bring it up
platform.
to see where your focus is. Investors, before you joined the bank, and Kevin a number of years ago, was basically a sleepy savings bank, a mutual savings bank who really didn't make any loans. And today you've grown it into a residential, commercial, and even a C&I business. Where do you see 2014 and future for the bank?
Well, again, I think interest rates are going to have a lot to do with, how 2014 shapes up in terms of lending. We've already seen a significant shutdown, if you will, in our residential business. I mean, as you mentioned, 10-year Treasury is up, 130 basis points over a 3-month period, and basically the refinance market is gone. We can't say the same about multifamily. Multifamily continues to be a strong business, but we're also concerned about, a significant, overheating of that market. And that's one of the reasons why, we ventured into C&I. C&I lending affords us, and when I look at the banks here today represented, I know you believe in the same thing, and that is the diversification of the balance sheet. Putting some money in different segments of the lending market so as not to get caught in one specific
So when
segment.
we talk about the buckets, okay, and let's look at the bucket where, many banks today, they say they can't put money out. I'm not talking about you, I'm talking about certain other people. And they say, the greatest area where I can put money out and I can get a higher rate of return, where I can get a floating rate, is I can give construction financing. And my rebuttal to this banker sometimes is, you also have the highest risk reward. Is it really worth that type of risk reward to get yourself another half a point today, when the potential risk is we don't know where the dance is going to be in a year and a half when the project's completed?
It's hard to rationalize when you have to factor in the capital you need to allocate to support that loan.
And your through cycle losses are really the key to it.
Right.
And the amount of capital then that's derived from that.
And,
I'm sorry, in your reserve, I mean, you think about the perfect loan, a 3-year loan, you fund it up, and then it pays off, right, when you get it funded. So you really don't earn, I mean, yet you're applying all the reserves and so forth for that. So we use it as a wedge product and for clients. But, the interesting thing about all this, Michael, is much as you're saying there's more banks coming and and it's good that the market is more stable today, and you can predict better where, your pricing is going to be and what the market's going to dictate. But there's still a lot of banks continuing to smart from real estate. So construction lending hasn't gotten overheated. And there's still banks that are, if you look across the board, more banks are declining in real estate than are growing in
But
real estate.
in
Of the top 20.
in the same manner, like I said to you before, I got a phone call about people saying, "Oh, I want to build a hotel," and I said, "What's your experience?" "Oh, I don't have experience." Or, "I want to build a hotel in Long Island City." I said, "There are 27 hotels in Long Island City. They're great, when the world is different, when there's a runoff from Manhattan, but the runoff may change."
I would suggest you're not seeing the long-term players and the people that have been in the market for a long time doing that kind of stuff. That's what I'd suggest.
And Michael, we've talked about this before. We learned our lesson in the construction industry a few years ago, and the biggest lesson we learned today, and again, you all mentioned it today, is equity. Is the developer's equity? Who is the sponsor? Are they over-leveraged? Now, when you look at a particular job, the one thing we want to look at is, what is the global picture of that particular developer? What else does he have going on? Because even though we may underwrite a project that works well, there may be 2 or 3 other projects that are not going to work well.
Many people sometimes, while the show airs around the world on the internet and other things, people just look at New York City. You're a New Jersey-based entity. You are Virginia, Washington, D.C., Virginia, entity who has business over there. You're a national entity also, and you're more of a regional entity. How is the rest? How do you see the rest of the region to do? Okay, New Jersey has rebounded in certain residential. Retail has done well. The office market is, as we would say, for dread. Okay, suburban New Jersey hasn't done that well. There's been repositioning of certain buildings. You know, you see landlords today taking property, Matt Calley being one of them, even Lefrak did it in Queens recently. They took these office buildings and they're repositioning the property. They're making them into residential because there's a residential need. How do you look at the other asset classes and the suburban markets when you look at loans and financing in 2014? Because you have budgets to go out of the market.
A budget is never going to permit you to make a loan you can't get paid back on.
No, I'm talking about your thoughts about the different markets, that's all.
We are a regional lender. We're very strong in Fairfield County. We're branching into Boston thoughtfully. And in New York, we're cautious. New York, the 5 boroughs, northern New Jersey, is an interesting place. You go out onto Long Island, it changes a little bit. Multifamily, when you can find it on Long Island, is interesting. I think that the office suffers from the same malady that Jersey suffers from.
In the suburban markets themselves, there's still a certain amount of softness in that market. What really has gained strength is some of the urban areas around New Jersey, some of the areas like Bloomfield and Clifton, and areas like that where people who have their children have moved out, they prefer to be closer to a train station so that they can commute into the city.
The transit-oriented development is a big thing. But you bring up an interesting situation. You know, everybody was very bullish, and I know that my friend Steve Pizicki, you know, put Panasonic in, Prudential's moving there. You know, you're a New Jersey-based bank. You've had business in New Jersey. What's your thoughts about Newark?
Newark is still not there, Michael. It's still an area that, you know, you have some you have some good spots, but overall, I think it's still a touch and go there.
Gino?
No, I was in Jersey today on a couple of calls with clients, and Hamilton has got a lot going on, and it's adjacent across the river, basically from Jersey. And there's a lot of money going in. There's public money. There's a lot of development money, and you're right. I mean, Jersey has a ways to go. Cory Booker's moving on to the Senate, maybe. We'll see. And you know, overall, we like the New Jersey market, though, and I think we felt. There's been a receptivity to what we're bringing to the table there that beats my expectations.
How do you like the New Jersey market?
You know, I've always liked the New Jersey market, and again,
I know you like the Pennsylvania market. Even
like the Pennsylvania market. I mean, you know, New Jersey and in Pennsylvania is not a robust, you know, boom bust or market, and they were fairly steady in most of New Jersey. I mean, office is struggling. Suburban office has been struggling for 20 years, right? So you take that out. Apartments do well in New Jersey. You know, retail. Fundamentally, our economy hasn't really improved that much, right? So you've got office and retail and those things. What you have is demographics favoring apartments, and virtually no stock was delivered in 2 years. So now you're catching up a little bit on that. So you've got, in Jersey City, now Jersey City, Hoboken, Jersey City, they really reflect New York. So that's not really New Jersey. That is reflecting New York.
As Josh Musk would say, I hate to agree, Jersey City's like the 6th borough.
Yeah.
I'd agree, but I was out there today. The guys delivered their building in January. They're 95% leased at $40 a foot.
Right.
I mean, who would have thought?
But $40 a foot, $40 a foot in Jersey City.
It beats 55 in Williamsburg.
Right.
Or 65
or 60 or 65
or 85
in lower Manhattan.
Yeah.
So the thing, I mean, we got really bullish on New Jersey. I think there's 8 projects were going up beginning of this year, and I had 6 of them. But we're a little bit worried about what's going to happen. So we track what deliveries are and all that. We still are bullish on the right people in Jersey City and in Hoboken. But again, you have to watch with all the, where are the cranes, and where are the new developments possibly going to go? Because you can. That's a market that you could overbuild.
There's a lot on the horizon, that's for sure.
The week before I had a show and we were talking about the Hudson Yards, and Steve Ross, who has truly been a visionary with the related companies, many of his, with the Time Warner Center and other things, has said, that the Hudson Yards will be the next Rockefeller Center. in 10, 15 years from now? I mean, as bankers, in the 80s, I still remember some vacant buildings that were built in Times Square. Too many of them because they didn't have tenants. Now, maybe there wasn't the discipline of the bankers of looking for a tenant. Do you see, and this relates to two markets, do you see the Hudson Yards really doing that well? And what do you see with Lower Manhattan? We have a lot of delivery of office space coming on the market. The general consensus from all of you is that the residential market is good, especially if it's suburban or nearby or transit-oriented development that you brought up before, okay, in Fairfield County over there. But let's look at two major areas, 26 million square feet on the Hudson Yards, 16 million square feet in Lower Manhattan. We have a lot of obsolete older buildings. What's your thoughts?
Look, I think there's a place where equity has to take the risk. Do I agree? Whether it's 10 or 15 years that down the road that's going to be great. The problem is you don't know what's going to happen between now and the next 10 or 15 years, right? Interest rates are going to go up. The cost of build is going to be higher than anybody's projecting today. Rents, office rents, I don't see them rising significantly right now. We've got an uncertain quality of life issues going forward because of changes in sort of perspective in government. Look, the pendulum has swung back toward non-business governmental leaders, and it remains to be seen what happens with quality of life issues down the road.
Yeah, I wish I had a clue as to whether
Yeah.
Hudson Yards is going to work
Right.
or not. And luckily, I'm not investing there, right? So, but
You're not investing.
I'm not investing.
not
Listen,
really
I think
putting-
there could be a long-term great play. It could be the next Rockefeller Center. The real issue is you build office on demand. It's very difficult to build it on speculation. We also have a completely changing office market. If you ask me today, lower Midtown is hot because it's funky, and the kind of companies, tech companies, and the kind of young employees, they don't want to work in the Seagram's building, right? That's pretty boring to go into a big front desk and you go up there. So what kind of office is really going to be in demand for
Sure they
tech
don't want to
and
move to
all of that?
299 Park?
I'm a banker, so I still like the big office, right? But I think there is some changing, and there's also changing where people are working at home, and are they sharing offices? Are they talking about
Hoteling has been around for years.
Yeah, but it's picking up a lot of pace on that, and people are looking at smaller cubes, and how do you stack? I think office is in a transitional stage right now. Now that doesn't mean I don't like well-positioned office on Madison and all that. Absolutely, but I wouldn't be necessarily doing a spec
What's your
office.
thoughts about Lower Manhattan?
Lower Manhattan has been one of those areas that's been in transition now for quite some time. I remember the days when people were moving there but complaining that there were no supermarkets. I still think that it probably has a little way to go in terms of its popularity, but we're still cautious.
Okay,
about Lower Manhattan.
since you and I are Brooklyn boys, I am still shocked when I go into certain parts of Brooklyn, and I was saying to someone before, I was at the groundbreaking for Northside Piers in the summer of 2006, and I remember walking the streets and making a deal, going to see a property which happened to be finally built this year by Richard Mack on North 6th Street. 7 years. Did anyone see Williamsburg in 7 years like this? I mean,
Hotter than ever.
It's
hotter than
I've heard
anywhere.
I've heard Williamsburg is so hot that people are going back over the Williamsburg Bridge to the East Village. It's just it's so hot.
We're going farther out into Bed-Stuy,
Yeah.
Bensonhurst. They're following,
Bushwick
they're following the
is the new
subway
Bushwick.
lines.
Yeah, right.
Yeah, it's just pushing out.
Greenpoint.
I told John before we saw a deal in Brownsville with a 5 cap. I mean, it was just incredible.
I really can't believe a 5 cap in Brownsville. I'm not ready for that yet. Fortunate enough, we'll have to open up again. We speak about different asset classes. We know that hospitality is a day-to-day operation. How do you, and you've had a lot of experience in hospitality.
Yeah.
How do you look at the hospitality market? I mean, and certain people say, "Oh, we got the Meadowlands. We have the Super Bowl." That's one weekend. Okay, there are different worlds.
You know, I was with a guy who owns a few hotels last week. It continues to boom. I mean, we do a lot of analysis on our portfolio because there's always concerns about hotel. The metrics just keep getting better and better. And I think the key to hotels is don't over leverage them.
Yeah,
If you're more than 55% leverage, or if you have a higher, don't do it. I mean, you just can't be leveraged on hotels because the cycles don't allow it. And people who are long-term hotel operators know not to do that, and that's who we bank.
Yeah, I think, Gino, we did the same. We just did a number of hotels in Midtown, and one of the keys there was, you know, the equity of the operator.
You did construction or takeout?
No, takeout.
We've actually just committed to both, and on both situations, we were sub 40% loan to value.
That's the way to do it.
That is the way to do it, because you got to project. You got to be able to live with some pain. So in other words, it's going to go and it's going to go fast, and then it'll come back and it'll come back fast. You know, you just have to be able to deal with volatility of hotels, and you have to pick the right
operator.
Because it is, you know, everything's the right owner and right operator, but it's a lot easier to manage an office building than it is, you know,
Or rent stabilized
restaurants.
multifamily.
Right, stabilized multifamily. Yeah, rent stabilized multifamily. I mean, but that's one of the other things that I think is a little bit out there right now is with governmental change. Interest rates, and you know, will expenses go up? The big fear to me, again, the big negative or whatever issue on rent stabilized or rent controlled is how much can they sustain expense growth, because you're sort of capped on where you're going to go on the revenue side.
You know, real estate taxes go up, water and sewer go up, insurance goes up, operating expenses. You know, it's great, but
And interest rates are rising.
and interest rates are
So
rising.
far, the Rent Stabilization Board has cooperated, but with the change going on,
You
it
don't
just
know.
it becomes political again.
Yeah, and I'm not saying there's anything against, you know, who may come into office or whatever. It's just an uncertainty, right? And we have had, you know, a long period of stability, and someone who you knew was, you know, liberal but logical in what they did. Very, you know, knew how to run a business.
Look, I remember 1990 when we had 2,400 murders in the city. If we ever go back to that, all bets are off.
All bets are off. When it's Needle Park instead of Bryant
Yeah,
Park.
exactly.
You know, in summation, 2014 looked like a very good year,
I think it's more
or a
of the
continuation
same.
of a
I think
2013.
it's a continuation of 2013 with a very close eye on interest rates and the impact the interest rates are going to play.
I agree with Gino, except for the residential market. I'm not sure where the residential market is going to go because of the level of interest.
How high do you see Treasury bills? I mean, look, we all felt that the 10-year Treasury at 150 was way too low. I mean, but I'm not an economist, and I don't project at the beginning of the year where Treasuries are going to be or where prime is going to be. Where do you see Treasuries? Do you see the 10-year reaching 5 within the next 12 to 14 months again?
I don't.
I think that's a tough one to see.
No, but I see 4 before I see 2.
Yeah. I would agree with that. I think Gino's right. I think we're going to, and if the government is, you know, again, if the Fed is smart and so forth, inching them up is consistently is the way to approach this, as opposed to either allowing a shock or then running back down again.
Last question. Do you think before 2014, 2015, there'll be a change with Fannie and Freddie in the government?
I don't think so.
15, you said? No.
So it's a longer-term situation.
Yeah, I mean, I think we're prepared for any change, and I think there's good dialogue going on, but I don't think that's the top of the agenda.
So I think that my audience and I have really got some good perspectives. I'm happy that I brought these senior bankers to provide their insight. I'd like to thank Gino, John, Domenick, and Rick, and I'll see you next week.